Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Jonathan Twomley. How you doing, sir?
I'm doing great this morning, Michael. How are you?
I'm doing wonderful. Every day is Saturday, and I like this topic. This is actually something you and I, people can go back on your playlist and realize that we warned people this was coming. You're going to kind of share what that is. Both share the good and the bad, because the simple action that we're about to discuss doesn't necessarily mean pain. It might, but also might mean strategic thinking. But so let's talk about what's going on in the syndication space, because again, we told people this was coming. So what are you seeing?
So what's happening right now is that a lot of syndicators have hit pause on distributions on their deals in the last few weeks, and it's because interest rates have gone up, and a lot of them have adjustable rate debt on their deals, and so their cost of debt service has jumped dramatically. Nobody expected when they went into these deals that they expected interest rates to go up, but they didn't expect them to go up like overnight the way that they have. So the problem is for a lot of syndication deals that are relatively new, they haven't had the chance to carry out their value add program and raise rents yet. So, and now they're playing catch up, right? So you're seeing a lot of syndicators pausing their distributions. Now, this could either be happening for a bad reason, or let's call it a less bad reason. But there are kind of two scenarios in which this could be going on. One is where the syndicator has no choice because they underwrote their deal very aggressively. They bought a rate cap or that was too high, like too much room to move, or they didn't buy a rate cap at all because rate caps are getting very expensive and they didn't want to buy one, and they rolled the dice. Sort of like rolling the dice on insurance. They didn't roll it, they rolled the dice on rate cap. And now they're scrambling to make their debt service, right? And they're really in deep trouble, right? These could be the first dominoes to fall in terms of foreclosures and that sort of thing.
Yes.
The second group is, which I'm happy to be associated with, is well-capitalized deals that have a lot of cash in the bank, but they're out of an abundance of caution, they're pausing or cutting the distribution to preserve cash and make sure that they have adequate liquidity and that they don't impair capital and they don't dip into that reserve fund in order to make distributions to investors, because the reserve fund is what is going to get them out of this, right? The reserve fund is what is going to enable them to carry out the value add and get the higher rents and then reach a point where they can start paying distributions again. But this is what's going on. This is, I've had several calls with syndicators recently where they've talked about this. Several of them have mentioned that everybody they're talking to is pausing distributions. Not everybody, but I mean, it's fairly common. If your deal is of more, I guess, seasoned vintage, right, where the value add has been completed and you went in earlier and you had fixed rate debt, then this is probably not an issue for you. Right. I think it may be a real issue in cases where people bought deals 3 years ago with fixed rate debt. They didn't think to buy a rate cap because they thought that this was not going to be needed because everybody was telling them interest rates will never go up, they'll never go up, they'll never go up. Look at the line,
Yeah.
Look, it can only go one way.
It only goes down.
It can't go the other way. People who listen to that.
It can't. Yeah, I love that. It can't go the other way.
It can't go, so, or it won't, right, was the other thing. But for people like that who didn't buy a rate cap, they may be finding themselves in a really sticky situation at the moment. So that's kind of what's going on, on the front lines of syndication at the moment.
So let's talk about being an investor. And again, I want to go back to discussions. Jonathan, you have an amazing playlist that people can go back and watch our discussions for years. My first word of caution is, as an investor, you need to figure out which camp you're in, right? Do you have a deal that's rather that was done recently with bridge debt into an environment that is changed rapidly, right? Is that what the distribution is? Is this an older vintage, which you've already had some increases and they're just being conservative? As an investor or an LP, you need to figure that out, because this is step one, right? And we've talked about this being step one. Step two is a capital call, right? And you need to figure out, as an LP, are you in a deal that may need a capital call because the world changed, or is it an operator that's got plenty of cash just being conservative and you feel good about not having one? Is it true that a capital call is kind of step two in these series of dominoes?
Yeah, and I'd say again, there's going to be like a really bad type of capital call and then a less bad kind of capital call. Okay. The less bad capital call, not that it's good, but the less bad capital call is going to be from, the syndicator trying to refinance the deal. And now because interest rates are rising, they can't get as much proceeds as they had expected. But, the capital call is going to go to top up the equity. You're going to be refinancing at a lower level of leverage, which makes the deal safer. And now you're set, and nobody's going to be buying variable rate debt anymore either, right? So they're all going to get fixed rate debt. So it's going to be painful, but your deal is going to be on a more solid footing, right? The bad kind of capital call is if they're calling capital to meet their debt obligations, right? Because they can't pay the debt, right?
Okay.
And that
makes sense.
That is a scenario that is, first of all, it's just going to be the first of many capital calls, right?
Exactly.
Because and that's a deal and what's going to happen in that deal is it's going to unravel, unless you have some white knight come in and save it. But you're going to have, because what's going to happen is people are just going to run out of money to fund these capital calls, and then or they're going to stop, or they're going to say, like, I'm not throwing good money after bad, or what have you. And then you wind up in a situation where they can't cover, and now and if your sponsor isn't deep pocketed and can't cover it themselves, then and you don't have an adequate reserve fund, that's going to be a sticky situation. So hopefully people don't find themselves in that position.
Yeah.
But that's I could see that,
Yeah, well, let's be real. I mean, we've been talking about this for a while. There are deals out there that we've said that deals are going to go that way. There will be some folks that lose properties that get taken back over by the banks because they were just structured with unrealistic assumptions, very risk. Again, I think I've said this 100 times. I saw in the commercial space the same idiotic stupidity that I saw in the residential market in 2006. Short-term debt, very variable rate debt with, that could go up shockingly, horrible rent assumptions, prices only go up, rates only go down, just crazy assumptions. And there has to be pain. Yeah. As an LP, let's talk to those folks, right? So pausing distributions, you need to figure out good or bad. Capital call, good or bad. And these dominoes could be months apart, quarters apart, or if in a really bad case, close. And then the last one is, the last step on the bad side is somebody takes over who isn't the operator that you signed on. Is that kind of the dominoes on the bad side?
I mean, look, depending on the loan documents, the bank could come in and it could potentially remove the operator for a better operator or a different operator, right? And I don't see that as being so likely, but I mean, it's essentially putting the deal into like receivership of some kind, right? And that's not a great situation because the receivers never really run the deals very well, right? They're not.
No, they become fire sales. I bought a couple of those last time.
Yeah, because they're not in the business of running of operating property, right? So, but yeah, I mean, that would sort of be the worst case scenario, let's call it. Now, I want to remind you, like the vast majority of deals are going to be fine, right? It's not like the whole industry is going to crash and every deal is going to
no, most will be okay.
Very true. I mean, the vast majority of them are going to be just fine. it's really the ones that have the combination of aggressiveness and bad timing at the very top of the market, bad assumptions, overly aggressive, and then you layer on top of that, just, when the market stopped bailing out bad assumptions, right? So, if you were unfortunately in a deal like that, then you may have something to be concerned about. But what I would do is, if you're I think the better syndicators out there, if they're stopping distributions, they're emailing their investors or explaining the situation.
Communication.
Yeah, they're engaging in good communication. They're telling you exactly why, and hopefully what you're seeing is them saying, we're doing this out of an abundance of caution. We have plenty of cash on the books, but we just want to make sure, in this time of uncertainty, we don't want to get caught, with our pants down, right? If you're seeing that kind of stuff, obviously nobody wants to have their distributions paused, especially if you need that money to live on, right? But if you're fortunate to be dealing with an operator like that, then I don't think your capital is really in danger. You're just looking at being disappointed by the return that you're gonna get on the deal, but that's not the end of the world, right? This is risk capital after all. But if you're getting kind of mealy-mouthed explanations from your syndicator, or bad communication, you probably want to get them on the phone and kind of find out what's going on. And frankly, these deals are structured so that you can't really get out of them, right? It's not a liquid asset. There are people out there who will buy LP positions, but they're vultures. They're not going to pay you what if you bought in at 50,000, they're not paying you 50,000, right? So, because they want to be guaranteed a return. So they're going to be paying you 25,000 or 20,000 or whatever it is. So you can get out if you really have to, but you're not going to be whole if you try to go to one of those players, right? So, just as always, this is when you're making these investments, don't use money you can't afford to lose. As generally safe a bet as multifamily is. And I know that, I was just reading today that BlackRock, I think it is, they're kind of doubling down right on this asset now, even as capital is kind of drying up. The insurance companies are pulling back, but some of the hedge funds are doubling down because they see this as a fundamentally safe asset. But those guys are dealing with institutional investments. They're going in at low leverage. Like it's all Class A stuff. Like it's a very different animal. Nevertheless, I don't want you to panic when you hear this or when you see your distributions being paused. But I think for additional peace of mind, you want to get to the bottom of exactly why.
You need to figure out what side of the fence. You need.
Yeah.
And let's remind people that we had distributions paused at almost all, if not all, syndications, kind of March, April of 2020. Right, the world was changing. Everybody paused, and that they started to come back on. I would say 5-6 months later, they came back when we figured out everything was okay.
Well, and again, that was so for deals, for some of your C deals, they never came back because some of those deals, those renters were the ones who didn't pay their rent, right? And some of those deals were pretty, strapped. But I think for anything that was a higher quality asset, once the initial shock of everything shutting down passed, and operators realize, hey, we're still collecting rent, and frankly, everybody's just working from home and they're getting their paychecks, then everyone breathed a sigh of relief. The difference though now is that the cost of operating your deal has just gone up. If you had variable rate debt, right, your income hasn't gone up, especially if you haven't done that value add yet, but your cost just went up. And maybe in a sense, you could be better off in a situation where the value add hasn't happened yet because there's still some upside left to the deal, right? If you've already done the value add, and you're kind of, you've reached kind of like the income level that you're going to get absent just natural rent growth from here on in, and suddenly your debt cost has, doubled, right? That's it. It is what it is from now on, right? So you just have to lower your expectations as to what you're gonna get from this asset.
I like it. Well, Jonathan, thank you for bringing this to us again. It's not necessarily a bad thing. It could be a very wise and strategic thing that your operator is doing this. I would caution you, it's your job, your responsibility as the LP is to figure out what side of the fence you're on. I will reiterate that most deals will be okay, but there will be some tragic stories, no doubt. And again, the assumptions I saw the last 18 months in multifamily was the same assumptions I saw in residential in 06. It was pretty comical.
I do want to make one more point before we close this segment, which is that, if you look at investment assets, right? Periods of high returns always followed by periods of low returns and vice versa, right? And the reason that exists is because at some point in the market, you buy at the top and then the market crashes, right? And I think a lot of investors, I've certainly seen it. I mean, let's be honest, multifamily investors, there's only been a few people out there who have been saying like, hey, this isn't going to last forever, right? Most people are out there saying this is going to last forever, right? And where you did see people warning about, we're going, the 2020s are going to be a period of depressed returns. They were in the equities market, right? And they were, so those kinds of investment managers, some of them, again, I mean, there's a lot of, happy talk too, but I was seeing some people commenting saying, hey, look, if you look at history, we've had this extraordinary run in the 2010s. The 2020s are likely to be a depressed return environment, but also the way you have to understand that too is like, if you invest after the crash, then you have a high return environment, right? Or at least you have, at the worst, kind of flat, right? The problem is when you invest at the top, right? So, and that's exactly what we're seeing now. For those people who invested at the top, you're going to see seriously depressed returns because cap rate, you've got the double whammy of interest rates going up and cap rates also going up, right? And I don't think cap rates are going to come back down to the same level that we saw them at the peak in 2021 or early 2022, right? So if your exit cap rate assumption was based off of that extraordinarily low cap rate that people were buying at last year, then I think that these deals just are not going to perform the way that they were projected to, right? And they're going to wind up being kind of like the dud in your portfolio, right? So, and if you invested in a lot of deals at the top, you're going to have a lot of deals that just don't perform all that well, right? But you should not let that discourage you from further investments, because the only way you make it back is in getting back in at the bottom, right? If you're saying like, oh, well, that didn't work out, I'm never doing that again, like that's really the wrong attitude to take. The way, this isn't doubling down, this is, doubling down is dumb. This is looking at the market and understanding that, after you've had a big correction, you've actually, the market is much less risky. You've actually de-risked. So it feels risky to people because they've just suffered a loss, but it's actually far less risky than it was at the top and when everyone's feeling good. And so the time to get back in so that you can essentially dollar cost average out those losses is to get in at the bottom and have some real star performers that make up for the duds that you invested in at the top, right? So so don't be discouraged, stay the course is what I would say. Opportunity is absolutely coming. I mean, I don't think there's anybody out there who doesn't think that opportunity is coming. And the pain will be limited to the kind of like badly structured deals that were bought at the top. So just keep that in mind.
Jonathan, you run an amazing Facebook group that is very active. What is that people can follow and let them know they came from ORET?
Yeah, please go to Multifamily Investment Community on Facebook. And please, there's some questions you have to answer. I really require people to answer them. I don't let you in if you don't, because invariably the people who I let in who don't answer the questions are the people who spam the group with some, BS about I invested in stocks with this dude, and you know, that some link to some spammer. So answer the questions, and I'll let you in. I also, if you want to join my mailing list, I have this, I haven't showed this for a few weeks, but I have
Oh yeah.
this free download, the ultimate checklist to getting your first 100 unit deal done with other people's money and getting paid to do it. This is a gosh, 40, 50 page, 57 page checklist that takes you through every single step of finding deals and syndicating them and growing a real estate business. So if you're interested in getting that download, go to apartmentinvestorsclub.com and you'll be able to find the download there.
Yeah, you definitely go get the download. It's free. I got it. It's amazing. I learned a lot of stuff. Jonathan plays in a space that I have never done. So Jonathan, thank you for educating and giving so much.
Absolutely. You're welcome.